it's Sam with Mesa Properties again, and I'm here with Sean again, Sean Bracey of Bracey Financial, and in this video, we're going to talk about the tax benefits of owning rental property. We're going to get into a bunch of questions that we get asked a lot, and you may know this because I might be sending you this video because you just asked me a question about a 1031 exchange, or what are the tax benefits going to be if I purchase this investment property? And I'll probably say something like, I'm not a tax expert. I'm not really supposed to say this. I've been advised by the association. I can't really get into these details, but here I am with the expert himself. Sean is going to be able to help me get into some of these questions, and then hopefully you'll find this useful. So Sean, if you could just tell us just a little bit about yourself for those who aren't familiar with you.
Yeah, so I'm a financial planner. I work with my family office here. My dad's been in business 33 years.
Wow.
I've been in business 10, so we've got a great working relationship. And so we do comprehensive wealth management.
Cool.
That involves taxes. So
Very cool.
Happy to answer some of the common questions. We often get realtors calling us. It's going,
yeah,
what's the cap gains issue here?
Yeah.
Sale. So
yeah, probably a guy like me, like, hey man, can you help me out? If you're interested, there is another video that we did with Sean that's talking about just all kinds of questions about what a financial planner does. So you can take a look at that if you're interested in learning a little bit more about what he does. But today we're going to talk about depreciation, 1031 exchange, stuff like that. So just to kick it off, Sean, tell me a little bit about depreciation when it comes to real estate.
Yeah, so the basic definition of depreciation is it's writing off the cost of an asset over a specific period of time based on the life of that asset, right? A computer only works for so many years before it breaks down and you can't use it.
Mm-hmm.
And so in business, you're able to expense that computer over the life of the asset.
Okay.
And so according to IRS code, like a computer is 5 years, right? Now, so with real estate, depreciation works on the building itself. And you have to depreciate the cost of the building over 27 and a half years.
27 and a half, that's the number.
Mm-hmm, that's the number. So now commercial real estate is, I believe, 32 years, but for residential real estate, everything 27 and a half years. There's no negotiating, that's IRS code.
Got it,
yeah.
Okay. And you said something there that I want to touch on, which is in business, right? So that's something that I like to tell everyone who's renting their house out. A lot of our clients are folks who rent the house out because they bought it maybe a couple years ago and they're able to buy another house without having to sell it. They save up or they're moving out of state or what have you. And so they end up renting the house. And I don't think everybody thinks about the fact that they're in business. As soon as you become a landlord, you go into business and there's some benefits there, but other responsibilities that come along with it. So that was just something that you said that I found interesting because that is a common theme for us.
No, definitely. And one of the things too is it applies to so many things, right? So the building is the main thing when we think rental properties. But anytime you have a tenant move out, right, often you have to replace the carpet.
Yeah.
And so you have the option with smaller things like that to depreciate it over the life of the asset. So how long that carpet's in place. Or you can do what's called Section 179, where you write it all off in 1 year. So maybe it's $3,000 to replace the carpet in that home, and you can do a little bit each year. Or if you have high income that year, that maybe you had lesser expenses on other properties, so the income's up, whatever the case may be, you may go, oh, I don't want to jump into a next tax bracket, or I just want to pay less tax. And you can actually write it all off in 1 year. You can't do that for the building.
Right.
But for smaller things like carpet replacement, new hot water heater, different things like that. And so there's planning involved with depreciation. It's not always cut and dry that you just do it.
Got it.
So that's one of the key things. And then also you can't depreciate land.
Right.
And that's something to always differentiate that plays into later with cap gains questions.
So if I'm a TurboTax guy trying to do this all myself, that may not be wise because I may not understand all the different little ways that I can depreciate something. Because like you said, carpet or something like that, that's interesting. And there is a difference between an expense and an improvement, right? In the way that those are depreciated.
Exactly.
Okay.
Yeah.
Or the way that they're written off, right?
Mm-hmm.
Okay.
Yeah. Yeah. So the improvements are typically depreciated. The expense is written off hard in 1 year. So.
Got it. Okay. So I rent my house out. I start collecting that rent. What is that income? Is that tax? Like, what's the deal with that?
Yeah, so rental income is considered and taxed at ordinary income rates.
Okay.
The benefit is it's usually passive income. And so with passive income, you don't pay FICA tax. That's your Social Security and Medicare, often known as payroll taxes that you do from your W-2
That I
job.
see on my pay stub.
Yeah, exactly. So you don't have that with rental income. So that's about a 15.2% tax savings that you have right off the top by the type of income it is compared to your job. So you pay less tax on that than you do because it's passive, but it is taxed at ordinary income rate. So whatever your tax bracket is, that's the tax rate you're going to be paying on that income.
Interesting. Okay, I hadn't even thought of that before. Where you're not paying all the payroll taxes. That's great.
Yeah, so that's a benefit to rental properties right off the get-go.
Okay, one con I guess would be then that that income does eventually stop at some point. A tenant moves out, there's vacancy period. So unlike a W-2 job, which hopefully is secure, rental income, it's as secure as you make it. But that's I guess one con that I thought of. Okay, so I rent the property out for a period of time, let's say 5 years, and then you know what, we really need to sell it. We want to get into a different house, or maybe we want to we moved out of state, and so we want to sell the property we have left in California and buy property wherever we went. What happens then? I've heard of these things called capital gains. Can you tell me a little bit about that?
Yeah, so when you sell a property for more than you paid for it, right, you have a capital gain. And so thankfully that income right now is not subject to ordinary income tax rates. You have capital gains tax rates, and those are judged by what bracket you're in. So the capital gains tax rates are 0%, 15%, or 20%.
Okay.
And so it's all based on what tax bracket you're in as to which of those three rates you're taxed at on the sale of that home. So that's how the capital gains work. Now, if you do a 1031 exchange, there are no capital gains.
Tell me about that. How do I avoid them?
Yeah, so if you sell the property and transfer all the proceeds from that sale into buying another property through a 1031 exchange, there's no capital gains tax. So you'd pay zero tax on all that gain from the one property, and now you've got it reinvested, hopefully earning more money in that new property than you were in the old one.
Got it. So how does that work? That sounds great. So do I just sell it, I get the money, and then I just go buy something else? But how do I tell the IRS that I was buying another property? What does that look like?
Yeah, so 1031 has some strict rules to it. So you have to identify, once you sell a property, you have 45 days to identify a new property.
Okay.
And then
that's not a lot of time.
Not a lot of time. So you really should have thought of it beforehand. Once again, planning is required in this. And so you can identify that property in 45 days, and then you have 180 days to close on the property and transfer the proceeds.
Okay.
If you don't do it in that time frame, then you're subject to the capital gains taxes.
Got it.
So you want to use what's called an accommodator on a 1031 exchange, and they make sure you meet those timelines. They do all the reporting to the IRS saying you met those timelines, and then eventually it's all reported on your tax return that you did this sale, but it's not subject to tax because you met those timelines. So one of the things to remember, though, is the basis of the first property transfers through to the next property.
Okay. Can you explain what that means?
Yeah, so the basis, what you paid for it, right? And so you end up getting a lot of pent-up gain 3 properties later. That $100,000 you purchased for, it doesn't reset at the new property. And that's key too if you have a California property that you're selling and doing a 1031 to out of state, is California has their hooks in, and if you ever sell that other property, you owe the gain on the first property back to California. You pay tax on that, even though you did a 1031 into another, maybe 3 properties down the road.
Really? So I can have done 3 different states out of California, and they'll still get me on the first one.
Yeah.
California is known for doing that. In fact, they actually have gotten us property managers to act as tax collectors as well, where if you live out of state, we actually have to withhold taxes for the FTB on your behalf. So a little bit of a different topic, kind of a side topic here, but that's another common thing that we get. Sean just made a great point. California will get their hooks into you. So if you are living in another state, owning rental property in California, and California sees you as a business operating in California, and they will get their state income tax. Even if you move to, say, somewhere like Texas that doesn't have state income tax, you will be filing a California tax return. So we may have to withhold that for you. It just depends. There's a bunch of different things that we'll do to try and not do that, but that does affect you. So California, it's got its great things, and it's on the tax side of things, sometimes not so much. So
yeah. One of the things to watch out too with capital gains is, so we've gotten this great benefit of depreciation over time.
Yes.
And so that depreciation is subject to what we call recapture. So if let's say you bought the home for 100,000
Okay.
and you sell it for 200,000, right? You've got 100,000 capital gain.
Okay.
But if you've written off through depreciation, let's say maybe 30,000 over the time you've owned that property, then that's subject to recapture. And so your basis is actually 70,000 because it's that 100 you paid minus the 30. And so your capital gain is actually greater. And the recapture tax rate's 25%.
Got it.
So you have to be careful if you're not doing a 1031 exchange. It's not just capital gains on the gain of it. You have to factor in that depreciation recapture for all those years you've been getting that tax benefit.
Got it. And in this case, if I'm selling that property with a $70,000 basis, then I'm moving that into my next property. That's what's transferring?
Yeah.
Okay.
Mm-hmm.
Makes sense.
All right.
Cool. And then I've heard that real estate is a tax shelter. This is just the term people throw around. I think a lot of times they don't know what it means. They'll say, oh yeah, I invest in real estate because it's a tax shelter. When people say that, what do they mean?
Yeah, so I like the term that real estate is a tax preferred asset. There's tax benefits to it. It doesn't completely shelter it. Like let's say if you contribute to an IRA, right? You don't pay any tax on that money going into the IRA, and while the money's in there, it is completely not taxed, only when you pull it out, right? But real estate, it has a lot of tax benefits, but you have to be careful in how you use those. But for example, the most common is depreciation shields your rental income. For example, let's just say we have a $500,000 home. And then let's say the building part of it is 300, land is 200.
Okay.
We've covered you can't depreciate land.
Right.
So you have 300,000 that you write off over 27 and a half years. That's $10,909 of an expense every year that you're not actually incurring, but that's shielding 10,000, almost 11,000 of income every year you're not getting taxed on.
And that can keep me in a lower tax bracket.
Absolutely. So that's why I call it a tax preferred asset. Because of the depreciation benefit there. Some people might go, well, is it good to run losses on real estate? Well, my theory is it's never good to run losses, right? You always want to make money.
The financial planner says that.
Yeah, but it's there are limits, right? If I believe it's your AGI is over 150,000.
Okay.
You don't get to take that loss on the rental property. And so it goes up and sits on the shelf. And then at any point in time you end up selling that property, then all those losses you put on the shelf over the years get to offset the capital gains on the property. But yeah, if your income's over the 150, then you're subject to the phase out that you can't take any rental losses.
Got it. So if I'm a buy and hold forever guy, then I may never be able to capitalize on that.
Yeah. So It's not always good to run losses on real estate.
Okay. Yeah, I would. This is a common question we actually get just on a more of a cash flow basis of, hey, I want to rent it out. My total monthly cost on the property is, $3,000 and the rental value is $2,800. Should I do it? Well, depends on what your other income sources are and what you think is going to happen with that. But
yeah,
you talk a lot about depreciation. We've kind of talked about that, but I have a hard time reconciling that just because the asset typically is appreciating, right? Like the home is going up in value, and yet when we write it off, or when we go do our taxes, we're depreciating it. Why is that? That's hard to understand.
Yeah, so if you didn't have someone like yourself maintaining the properties for all the your tenants and everything, right?
Yeah.
If the home just sat there, it would decay and fall apart, right? It takes that maintaining it and care and management. And so that's why if all you did was leave it there, come back in 27 and a half years, that home's going to be falling apart.
Gone,
right?
maybe, yeah.
Yeah, and so that's why the IRS has it set up that they allow this expense over time. So if theoretically you get to that 27 and a half, you've been able to take that expense through time, not all at the end when the asset is worthless.
Okay.
So it's kind of weird with real estate because real estate typically goes up in value, right? But it's through that care and maintenance ongoing. So it's one of those neat tax things that we get a benefit from.
Yeah.
That doesn't always logically make sense.
Yeah. Gotcha. Okay.
So another thing that is a benefit as a tax shelter is in more recent year tax legislation, there's what's called the QBI deduction, qualified business income.
Yes.
And that is a deduction of 20% of the net income of the business. Well, it also applies to rental property
because it's a business.
Mm-hmm. And so it falls under the I believe it's the enterprise rental. I forgot the whole name, but and so if you meet those IRS guidelines and definitions, and you spend 250 hours a year on managing that property. Now, the great part is it's not you individually, is your hours for your clients count towards their 250 hours.
Interesting.
The plumber you hire to go fix the leak, or the air conditioner guy to repair that, their hours count towards your client's out 250 hours. So if they meet those rental enterprise guidelines and you're tracking some of those hours for them, because that is one of the requirements, you have to have a contemporaneous log, then they get the QBI deduction on the rental property, which is another 20% off the net income of the rental.
Wow.
So there's several tax benefits there.
Yeah, absolutely. That was one that I was not aware of on QBI. So anything else that you can think of, just like last thoughts on benefits owning rental property?
Yeah, so one of the big ones, it's a great way to transfer wealth, the step up in basis. And so the way I like to think about it is, right, I've got my grandparents, they bought their home for like $25,000 back in 19, you know,
that's what an earnest money deposit is these days. In escrow,
And so that's their basis, right? And so if they were to sell that home today, it's about 800,000.
Sure.
There's a huge capital gain there. But when they pass away and all, you know, my parents inherit the home, then they get what's called a step up, which is the basis isn't that 25,000 that my grandparents originally paid. It steps up to the fair market value. And so now if my parents were to sell that property right away, there's no capital gains tax on that property.
Assuming they sell immediately, right? If they hold it, then it continues to appreciate that.
Exactly. But their new basis is that watermark of the fair market value when they inherited it.
Instead of paying a $725,000 capital gain tax, which would be crazy.
Yep. Yeah, it would be. So that's one of the benefits, is the step up in basis. And then what's great is that step up in basis also works for depreciating, right? Because it's not, let's say they don't sell it, but they want to turn that into a rental property now, is they're not depreciating the original 25,000 over 27 and a half years. They're using the new 800,000 number over, well, minus the land.
Sure.
But that new number over the 27 and a half years. So there's a tax benefit there. So the step up in basis is a really big benefit for long-term real estate ownership and transferring wealth from generation to generation. Unfortunately, due to Prop 19 that was passed in California last year, there is no step up for California. It's still there for the federal, but you don't have it for the state purposes now.
Got it.
That's one of the downsides. We may need to do an update video in the future, given tax law proposes.
Sure.
They are proposing maybe taking that away federally, as well as 1031 exchanges. So there's a lot that remains to be seen, and what happens there, we'll have to kind of keep tabs. But for right now, under the current rules, those are some huge ones. The other one that goes along that step up is what we call portability. And so it's really key when a spouse passes away, that you file a 706 return electing portability, because factoring back to that depreciation, if you have rental properties and spouse passes away, the other spouse inherits their share because everything's 50-50, let's say. And so that steps up and you get to restart depreciation at that new higher market value. So if you've owned those rental properties for decades and maybe they're almost depreciated. I had one client, they actually were completely depreciated. They'd owned the property that long. The husband passed away and we restarted at the new 800,000 market value for that rental property, depreciating all over. So she got a nice tax benefit again, where she had crept up into some high tax brackets.
Gotcha. Yeah.
So yeah, portability is something often overlooked that's actually a huge benefit for spouses.
Okay. Well, hey, if your head's spinning like mine feels like it is a little bit, just all these different strategies, and there's just so much to know, especially when it comes to the tax code, and you are, thinking that maybe you need someone to help you out on taxes, Sean is definitely somebody that we at Mesa trust and would recommend. And Sean, if somebody wants to get in contact with you, how would they do that?
Yeah, best way is our website, which is just braceyfinancial.com, www.braceyfinancial.com, and you can reach us there. We have a contact us page. All our information's there. You can learn a little more about that.
Awesome. All right. Thanks, Sean.
Yeah.